Rob Moise, and today we got a good old-fashioned investing debate. We are going to tackle one of the age-old questions for Canadian investors: is living off dividends in retirement a good idea? It's certainly a popular idea among some retirees, the idea being that you build up a nest egg of dividend stocks and you live off this steady stream of dividend income without needing to sell your shares to fund your lifestyle, as is sort of the more traditional approach. Now, this sounds simple, it sounds compelling, but is it all it's cracked up to be, or might there be better ways to retirement bliss? Well, we have two DIY investing titans here. They're going to battle it out for us and help you decide what makes sense for you. And listen, I'm no wrestling hype man, but I'm going to give my best shot here. In this corner, arguing for the idea of living off dividends in retirement, is Kanwal Sarai, founder of Simply Investing, a community dedicated to helping others learn how to become dividend investors. And in this corner, arguing against the idea, is Dan Kent, founder of Stocktrades, a website aimed at helping DIY investors with stock research and investing education. Gentlemen, great to have you both back with us. You're repeat guests here. Wonderful to have you with us. Looking forward to a spirited debate. You guys in the fighting spirit here? What say you?
Yeah, let's do it.
Excellent, excellent. Now listen, before we dive into the debate itself, just want to get a little bit of background on you guys, fill our audience in for those who may not be familiar with you. Kanwal, let's start with you a little bit here. Just tell us what made you decide to become a dividend investor in the first place?
Yeah, sure. Thanks, Rob, for having me here. For me, the big thing was the stability of dividends. They're reliable, they're consistent, they continue to grow every year, and that growth allows me to beat inflation over time. And so it's a great way for me to invest in dividends. Now, just very quickly, Rob, for your audience, some of them who may not know what dividends are, it is essentially the company sharing its profits with you, the shareholder. So, for example, if you have 1,000 shares and a company is giving a dividend of $1 per share, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. You can spend that money if you wish, or you can reinvest it.
Right, and you're speaking of reinvesting, that's something that you've been doing throughout your investing journey here, and now you're well on your way to one day living off of dividends in retirement. I'm just curious, what sort of knowledge, habits do you think it takes to be a successful dividend investor, perhaps ones that you've pursued in your own life?
Yeah, absolutely. And I've been doing this for over 25 years now as a dividend investor. A couple of things you need to know. You got to know what to invest in. What is a quality stock? We just don't invest in any stock that pays dividends. So quality means taking a look at what's the debt level? What's the payout ratio? What are the earnings? Is the company profitable? How to know if a company is undervalued or overvalued, right? So that's key as well. So you got to have that essential knowledge of how to select quality dividend paying stocks when they're priced low.
Right, and that's something that you deal with your community, helping people understand a lot of these metrics and stuff like that you mentioned. And yeah, it does take a little bit of work to become a dividend investor, certainly, but it's certainly an approach that a lot of people like to pursue. Now, on the other side of the coin here, Dan, you are what we would call a total return investor, which means you're kind of investing in stocks that you feel will appreciate in price over time primarily, but you're also kind of enjoying other sources of return that they might offer, interest, dividends included. What made you take up this approach?
Yeah, so for the most part, actually, when I started investing, I was actually a pretty big dividend growth investor. The same thing. I would try to identify companies that were growing their dividends consistently, to ultimately increase that stream of passive income. But I mean, after I swapped in them, it was around 2017, I kind of made the switch to a total return aspect, mostly because I noticed my portfolio it was just lagging benchmark indexes, just returns I could get from simply buying a single ETF and doing nothing. So, I mean, after that, I kind of thought, with my time horizon being, 20, 30 years, I just felt that, trying to invest for income at that age wasn't really the goal for me, especially if it was ultimately costing me. I mean, even if it's something as tiny as, you're lagging a benchmark index by maybe 1% a year. Once you factor that in over the long term, it definitely does add up. And I kind of sat there and thought, in a couple decades when I retire, I, might have less money aiming for this strategy now. So I kind of just restructured my portfolio to effectively measure my returns based off those indexes rather than the actual generation of income.
Mm-hmm. It is interesting to hear that you also liked dividend investing at a time. So, and obviously they still play some role in your portfolio. Maybe you can give us a little bit of clarity on what role they still play in your portfolio in a way that kind of differs from what Kanwal is doing.
So the one thing about somebody who maybe likes dividends and they have somebody that's arguing total return is they kind of sometimes think that you have to be chasing after these high growth stocks that don't pay dividends, the high volatility, things like that. But the thing is, a dividend is a portion of total return. So as somebody who argues towards trying to maximize your total returns, it includes dividends. So obviously they're an important part of my portfolio. Would it change my overall mindset if those companies somehow obviously this is a completely hypothetical situation, but if those dividends just turned into stock price appreciation, it would mean nothing to me. The income actually doesn't mean much to me because ultimately I'm looking for the maximum amount of returns from my portfolio, all while, taking the lowest risk possible that I'm comfortable with, at least.
Okay, so we have these two contrasting approaches. Guys, thanks for sharing your perspective on investing and how you guys do it. Now let's get down to our debate, to live or not to live off of dividends in retirement here. And I just want to go over some of the ground rules before we get into it here. You're each going to have a chance to present your opening arguments for your position, and then you'll each have 2 opportunities to counter your opponent's arguments. I'll jump in with some questions of my own afterwards to kind of fill in some gaps in the conversation here. And then our audience is going to vote on whoever they feel made the stronger case. And here's the key here. Whichever debater can swing more viewers to their side is going to be the winner, okay? Now, please avoid interrupting as your opponent makes their case so we can kind of keep the conversation moving here. And viewers, please submit questions you have along the way. There's going to be a Q&A session towards the end here that we're going to pick our debaters' brains here. You can use the question and comments box in the broadcast console to submit those questions and comments to us. And if you're joining us on our YouTube live stream, just a heads up that if you want to have your voice heard, you want to vote on things, you want to submit a question, there's a link in the description that you can click on. You can register for this event here, hop into this broadcast platform. You can cast your vote, you can ask your questions, and all that good stuff, okay? With all that said, let's get things underway here. And we're going to kick things off with a heat check from our viewers, because we want to see where do people stand before they hear the arguments for and against living off dividends in retirement. So again, if you're joining us in our broadcast platform, you will be able to see the votes on the screen here that you can cast your vote here for the options. Again, the debate question here is living off dividends a good idea? You could choose yes, living off dividends is a good idea. No, living off dividends is not a good idea. And of course, for all you fence sitters out there, there's also the option, I have no idea either way. But listen, you're going to have to get off the fence eventually, okay, by the end of this conversation. So keep that in mind. We're going to reveal the results of our heat check in just a moment here. But I'm curious, Kanwal, Dan, do you guys think that you have the wind to your sails, so to speak? The audience is already on your side? Or do you think you're going to have an uphill battle to fight here? Dan, I'm going to start with you. What do you think?
I mean, it's difficult to tell. It kind of depends on the audience overall. I would say that I will have the uphill battle for sure. People love dividends. They've always loved dividends. So I think I'm going to be in tough, but I might be surprised.
Okay, Kanwal, what about you? What do you think? Would you agree with Dan's sentiment, or do you think you're going to be the underdog in this situation?
Yeah, I am surprised to hear Dan's comment, but I'm going to have to agree. It's very hard to tell. It can go either way. I think I'm going to have an uphill battle, but let's see.
That's interesting. Yeah.
That's in some level very gracious of both of you guys, thinking that the other side's got the upper hand here, right? Maybe are you guys maybe setting the bar low so that you can overachieve? I don't know. We'll see. I will say, from my experience, certainly Canadian investors do have a reputation for loving their dividends. So I wouldn't be totally surprised if, Kanwal, you had the wind at your sails, so to speak, here, and more of the audience was on your side. But hey, I'm willing to be surprised here. So why don't we take a look at the results of our heat check here, see where do our voters stand here. Overwhelmingly, 75% or so saying yes, living off dividends is a good idea. Okay, so Kanwal, You definitely have the audience on your side, so to speak. But listen, you have to maintain your edge at least here, okay? So that's going to, again, determine who's the winner of our debate here. So let's get into the conversation here. And Kanwal, might as well start with you here with your opening arguments. Make the case for us. Why is living off dividends in retirement a good idea in your opinion?
All right. Thank you, Rob. Yeah, so I've got 7 key principles, and I'll go through them fairly quickly because I don't want to take too much time here. And those are the driving principles behind, how I invest. And as you've mentioned in the beginning, I'm a dividend investor, have been doing this for over 25 years. So principle number 1 is I only want to invest in quality stocks, right? I mentioned that before. So if you've got 2 companies, A and B, all things considered equal, company A has a debt of 500%, company B has a debt of 2%. Well, I want to invest in company B. I don't want to put money in company A. So quality stocks. Number 2, I want to make sure that the stocks are undervalued. Price low, not high. Number 3, I want to get paid for owning those stocks, right? Not just when I sell them, but just holding on to them. I've held on to stocks for 5, 10, 15 years. And so I want to get paid every quarter. And that is in the form of dividends. Number 4, I want to make sure the portfolio is generating growing income every single year, and that growth should exceed inflation. Number 5, I don't want to have to sell my stocks. I don't want to eat into my capital at all. Number 6, I don't want to invest in volatile stocks. I know there's lots of stocks out there. I don't know if we can mention any names, but there's high growth stocks that go up 30, 40, 50% like in a couple of months. Right? But they can just drop as easily 40, 50, 60% in a couple of months. So I want to avoid volatile stocks. And the last one, number 7, is I don't want to have to pay annual fees. And that's the management expense ratio. So if you're looking at mutual funds, index funds, or ETFs, you're still having to pay the fee. So I want to avoid that. So those are my 7 principles, which I hope will resonate with the audience as to how I approach dividend investing.
Right. And then just to kind of clarify a little bit, so living off those dividends in retirement, then why do you feel it's so compelling, though? You've got, in your mind at least, a good cache of stocks here that are going to do a lot of the things that you like. What makes it so compelling for you to live off of them?
Yeah, absolutely. The biggest compelling thing is predictability, right? So the dividends, in my opinion, are reliable. They're consistent, and I can easily predict out into the future of what my dividend income is going to look like. I can't do that with stock prices because stock prices go up and down. Some politician or some influencer could say something online which would either drive prices up or drive prices down. I have no control over that. But when I look at companies, and I'm sure we'll get into it later, but look at somebody like Coca-Cola, 62 years of consecutive dividend increases. So that gives me predictability, consistency, and reliability. And over the last 25 years, right, I've seen the markets, I've gone through market crashes. We've had the one in 2008, 2009 financial crisis. We had COVID. But I can tell the audience, and we've chatted about it before, Rob, over the last 25 years, my dividend income has increased every single year, regardless of what happened in the stock market.
Okay, I mean, I think a lot of retirees who certainly like predictability would sign up for that kind of arrangement. So, Dan, we've heard Kanwal's opening arguments. Now it's your turn. Make the case for us why living off dividends in retirement is not a good idea in your opinion.
Yeah, so I think the idea of living off dividends in retirement is kind of a situation where it's a bird in hand is worth 2 in the bush type situation. You have that income now. Stock price returns aren't really all that guaranteed. However, I mean, we have probably a century's worth of data that kind of shows what the typical markets will perform. If your time horizon is longer, this gets even worse. Like the longer your time horizon, I mean, the more, I wouldn't say guaranteed, but the more likely you are to realize higher returns. And the situation between dividend stocks and retirement, I mean, this necessarily wouldn't be the case if you managed to pick a market-beating portfolio of dividend-paying stocks. But I mean, we have a lot of data that kind of highlights that most retail investors will underperform the market, often substantially. So picking stocks at low values and kind of holding them, generating that income, it seems easy on the surface, but I mean, it's not really that easy whatsoever. And I mean, we have a lot of data from that. I mean, dividend focused portfolios are primarily constructed on loss aversion, which again is like it's a very powerful human emotion. I mean, there's a lot of studies out there that say we fear loss much more than we kind of chase gains, I guess you would say. But the thing is dividends are not guaranteed. They're not guaranteed whatsoever. I know he had mentioned Coca-Cola. I would counteract that with 3M. They paid dividends for a very long time. It got slashed. The stock price went in the tank. The COVID-19 market crash. I just have some data from the COVID crash. So we had the fastest pace of rate cuts in history. So according to Janus Henderson Research, when the pandemic hit, over the preceding 2 quarters, $220 billion in dividend payments were lost. This accounted for around 12% of total payments. And of all the U.S. listed companies that cut dividends in 2020, 40% of them were still not paying them 2 years later. So assuming your dividends won't get cut because you've maybe heard of a blogger that had they survived a numerous amount of crashes, or you survived some yourself, that's just kind of confirmation bias. They're not guaranteed. You never know what next event is going to hit the market. I mean, nobody could have predicted the pandemic either. But the main arguing point for me, and this is going to be most important for retirees, is the element that dividends do not reduce sequence of returns risk. So sequence of returns risk in a nutshell is the timing risk of your withdrawals in retirement. So a lot of people are fearful that if the market crashes, they'll still have their dividends if the market crashes. So you may not have referred to it as sequence of returns risk, but if you're building a dividend portfolio for the sole purpose of if the market crashes, you'll still have your dividends, you are attempting to mitigate sequence of returns risk with dividend income. And there's just been no studies whatsoever by highly accredited researchers that have ever mentioned that dividends mitigate sequence of returns risk once. There's actually, contrary to that, like dividends increase. If you build a dividend based portfolio, there's very likely you are increasing your sequence of return risks. And if we look to 3 core ways to mitigate sequence of returns risks, and again, this would have come from those researchers, we look for flexible withdrawal strategies. The second we look is to build cash reserves. And the third is diversification among assets that are not positively correlated. Literally none of these apply to a dividend-based portfolio. You can't be flexible as your income is limited to your dividend payments. You're not building cash reserves because that would ultimately require you to, say, sell assets and allocate some of that to, say, fixed income or cash, which ultimately would reduce your income. And diversification across assets that are not positively correlated. If we look to the sectors in the US and Canada that pay dividends, it is highly, highly concentrated in 2 or 3 sectors. So you're actually doing the complete opposite of what many very, very smart researchers have stated for many, many years about actually reducing sequence of returns. I mean, if we look to William Sharpe, who he won a Nobel Prize for development in regards to portfolio theory and developed pretty much the barometer for risk-adjusted returns, the Sharpe ratio. He never mentions dividends in order to reduce sequence of returns risk once. In fact, like they've had numerous studies that pretty much outright state there's zero evidence to point that they help. On the flip side, if you think about a total return strategy, which utilizes both dividends and capital gains from the sale of shares in retirement, that maximizes your flexibility. It allows you to build cash reserves, and it also allows you to diversify your portfolio. So, I mean, cash reserves and the transition of capital to more conservative investments like fixed income, it can be done pretty easily during market run-ups, which allow you to be much more flexible during drawdowns rather than relying on that static stream of dividend income, which is not guaranteed whatsoever. And because you're aiming for total return, you're also not as concentrated, which kind of reduces that element of assets that have positive correlation. So, and then the final point I want to go into, but I don't want to mention too much just because it's so independent, is the taxes. So for most, capital gains would be the more tax-friendly form of income. And then again, it allows you to be very flexible because dividends are taxed in the year you receive them, whereas capital gains, you can defer. They're only really taxed when you sell shares. And many Canadians will structure their portfolio towards Canadian dividend stocks because they're more tax friendly. Obviously, we have, eligible dividends are tax deductible, or not tax deductible, but they have tax benefits. The thing here is we directly go back to that sequence of returns risks where you want a diversified portfolio that isn't strongly correlated with each other. If you make the majority of your portfolio Canadian dividend stocks, you're doing the exact opposite. And yeah, I think that's just the overall argument from me. It's if you're structuring it based to provide you with income in retirement, that is in effect trying to reduce that sequence of returns risks, whereas every study pretty much says doing so increases it.
Okay, a lot of compelling arguments that we heard from both of you here in your opening arguments. So let's get into the counterpoints. Right, this is where things get a little spicy here. This is where the debate is made or broken, I think, in a lot of ways. Kanwal, let's go over to you. Dan made a lot of points here about living off dividends not necessarily being, let's call it, the most efficient approach. Is kind of the overarching theme I've got here. How would you push back against some of the arguments that he's raised in his argument there?
Sure, absolutely. Yeah, lots of good points there. So if we can, we'll start with the most recent one with the taxes. Just a quick example for your audience. Canadian dividends are taxed the least in Canada here. For example, if you were living in Alberta, and this is outside of your TFSA, outside of your RRSP, and if no other source of income, you could make up to $65,000 a year in Canadian dividends and pay no income tax at all. That includes federal and provincial. The same $65,000 as a salary, you'd be paying over $16,000 a year in taxes. So there are benefits to earning Canadian dividends, and especially for retirees, right? You're retired, you have no other source of income. You could potentially earn, like I said in this example, in Alberta, $65,000. With a spouse, you're looking at $130,000 total household income. $130,000 in Canadian dividends outside of a registered account would be tax-free. And then, so there's other examples, but we don't have time to go through all the provinces right now. So we'll leave it at that. The other thing with the dividend cuts, absolutely, right? During COVID, we saw Boeing cut their dividend, General Motors cut the dividend, Disney, all three of them cut it to zero. Now, the good news is Disney is back with dividends, so is General Motors. Boeing has not brought the dividend back yet. And then if we look at the financial crisis, 2008, we'll even broaden it from 2007 to 2009. Within that time period, dividends fell on average by 20%. But at the same time, stock prices fell by more than 60%. So a huge drop there. The key thing to remember is when you're looking at the studies, they're looking broadly at every, when they're looking at dividend stocks, it's every dividend stock out there in the US or Canada, and there's lots of them out there. If you'll remember, my first principle was we are looking at quality stocks, right? Are these companies recession-proof? If not, we don't invest in it. Does the company have low debt? If it doesn't, we don't invest in it. The payout ratio's got to be low. We have to look at a 20-year history of the company's profitability, their history of paying dividends, right? So a lot of those companies that did cut the dividend would have been avoided right off the bat. For example, and for myself, and again, we don't have time to go through the 12 rules of simply investing, but we never would have bought Boeing in the first place. We never would have bought General Motors in the first place. So when COVID hit and they cut their dividend to zero, there was no impact to my portfolio. And in that year, I actually saw my dividends increase again, like they've done for the last 25 years. The last thing, if I've got a little bit more time there, Rob, I was just checking in. And the last thing is going to be the fees, right? The fees are, they seem small at the beginning, especially if you're investing $1,000, $5,000 into ETFs or index funds or even mutual funds. But even a small fee of a 0.05 MER, annual MER, that doesn't seem like a lot. That's half of a percentage point, right? But when you start getting to larger amounts, and that's where we hope all Canadians will eventually get there as you get closer to retirement, if you're sitting on an $800,000 portfolio, right, over 30 years at a 0.05 MER, you're looking at over $126,000 in fees. And I would rather Canadians save that money for themselves. That's $127,000 is a lot of money. And it just gets higher and higher if the more you're investing, right? And in this example, I'm assuming for 30 years, you stop putting any more money into your RSP. And most Canadians don't do that. They invest regularly every year, right? Putting money in. And so then those fees will just get bigger and bigger over time.
Okay, so a solid counterpunch here from Kanwal, Dan, talking about some of the tax benefits of Canadian dividend stocks, talking about honing in on a more reliable or perceived to be reliable stream of dividend income here. Two of the major points we're seeing here as well. What would you say to his counterpoints?
So I guess the first one I would mention in terms of volatility. So I ended up running a few back tests on Canadian and U.S. dividend aristocrats, and I kind of compared them to like a broad-based all-in-one fund, the S&P 500 and the TSX index. I did, I think, 65% Canadian, 35% U.S., and I kind of realized over pretty much any time period over the last 20 years, they exhibited the highest risk-adjusted returns out of any of the other options. So, I mean, first off, picking stocks is very hard. In regards to the fees, most retail investors, and this would include people in retirement, this is U.S. data. I would imagine Canadian data is much the same. They underperform the benchmark indexes by almost 3% annually. If you think of how minimal a 5 basis point fee is versus underperformance of 3% on an annual basis, I mean, you're talking, it's mind-blowing amounts of money over the long term. In terms of the taxes, I would argue that this applies to very, very few people. So this is if you don't have any other taxable income. I believe I looked it up. Almost 38% of Canadians have some sort of employer pension. That doesn't include CPP. That doesn't include old age security. That doesn't include RSPs, withdrawing from your RSPs. If you have any other form of income, that taxable free dividends does not apply. I've been doing this since 2016, and I've met 3 people, interacting with all Canadian investors over the years. I've met 3 people that meet this criteria. So in that regard, I think when we're speaking on those tax-free dividends, we need to understand that you might fall into that bucket. Obviously, I can't say, but ultimately, you probably don't fall into that bucket, just because, I mean, I know I will get CPP. I paid into CPP. I have an employer pension back when I worked for my employer, so I won't ever qualify for that. So something like that is kind of a counter argument to the taxes. And then in terms of the I'll never buy bad stocks, people buy bad stocks all the time. I mean, there's a situation we can think with a company like BCE over the last 5 years. I mean, the company did very well leading up into the pandemic. It grew its dividend. It had a very long history of dividend growth increases. The only reason the dividend didn't grow was back when the teachers' pension plan wanted to buy them, so they couldn't raise it. But ultimately, this is a company that paid dividends, grew dividends for a very, very long time. And now we look... right now, I believe they're almost 40% off highs. Dividend growth has slowed. And this is one of the most popular stocks among Canadian retirees. It's the most popular stock among a lot of Canadian dividend income funds, which, by the way, I looked up all the Canadian income funds. I could not find one that outperformed the TSX index over the long term. So that's another justification in terms of fees. If you're underperforming the benchmark by a percent or two, a 5 basis point fee is irrelevant, in my opinion. But yeah.
Okay, so those are some pretty good counter punches again here. I'm loving the spirited debate here. You guys are really doing a good job of pairing each other's arguments here, so to speak. Kanwal, let's give you your final arguments in favor of living off of dividends. Any counterpoints you have to Dan's position? I think he made a really good point there about the difficulty in picking stocks. As any stock picker can tell you, it's a challenge to pick the ones and totally avoid dividend cuts. with a good example of BCE, and I'll throw in another one, Algonquin Power, not too long ago too, which was also thought to be a darling in some dividend investing circles, and they also ran into some trouble there. But give us your final arguments in favor of living off dividends, Kanwal, and any final counterpoints you have there.
Yeah, absolutely. Thank you, Rob. The other thing I wanted to mention that we haven't talked about was dividends cannot be manipulated like companies can manipulate the earnings per share, right? So the dividend has to be paid from the company's earnings and cash flow to the shareholders. So to me, that is the strongest indicator of a company's profitability, right? Earnings can go up and down, stock prices go up and down all the time, but a dividend, again, consistent, reliable, and you can look at the history going back 20, 30, 40 years, and it can give you some level of confidence as to what's going to happen in the future. Like, no one can predict the future. I don't know what's going to happen to stocks or the stock market, but looking back, we can have some degree of confidence that, company has paid a dividend, has increased it consistently, that I'm going to be getting some amount of dividends going forward into the future. The other thing with the not being able to select quality stocks, right? So the other thing what we can do to that is we do diversify, right? We don't put all of our money into one company or into one stock. So we're diversifying myself as a dividend investor across different companies, different industries, different sectors that are paying dividends, right? So when something like, BCE seems to be slowing down, time will tell in the next 10, 15, 20 years where the company ends up at in terms of their dividend growth. But having that diversification gives you a little bit more stability. And the biggest thing for me is being able to not have to sell my shares. I'm not eating into my capital, and I'm able to predictably forecast what my dividends will be going forward into the future. The worst thing that can happen to an investor, right? So we talked about index funds and ETFs, and some of those funds have dividend stocks as well, right? So, we're not completely talking about non-dividend stocks versus versus dividend stocks, right? Some of those funds do carry dividend stocks in there. But the biggest thing that, to me, that can happen to an investor is you get close to retirement, right? You've invested all of your money in either high growth stocks or stocks that don't pay dividends, because that's where you put all your focus on, right? Now, when you get to retirement age, now you need to start withdrawing money from your portfolio. And a lot of people follow the 4% rule, right? I'm going to take out 4% every year because my portfolio is big enough and I can just live off of that, right? I don't need dividends. I'll just live off of that. The worst thing that can happen is if we end up in a market downturn or a market crash that lasts 24, 36 months, a long extended period of time, now you're put in a very difficult position of having to sell 4% of your holdings because, theoretically, assuming you have no other dividends, you got to sell 4% of your holdings now to live off of that money. And if the stock prices have tanked 10, 15, 20%, that is the worst time to sell, right? So as a dividend investor, I don't need to worry about selling my stocks to live off of that. I'm going to live off the dividends.
Okay, great final summation there, Kanwal. Thank you for that. And Dan, we'll send it over to you there for your final arguments and any sort of final counterpoints you have there for Kanwal. I think he did bring up some interesting points there, particularly around the sequence of returns risk right before retirement, which I think some investors might suggest would be more pronounced for somebody who's relying more closely on price appreciation as opposed to dividend income. They could potentially take a bigger hit from a market downturn than someone living off of dividends. What do you think about that? And give us your kind of final arguments for why living off dividends not a good idea in your opinion.
So, the most interesting element of that is it's actually investing in dividend stocks that amplifies that risk of a drawdown. So, again, when I mentioned the core foundations of reducing sequence of return, it was flexibility, it was building cash reserves, and it was not being too concentrated. So you would be assuming that somebody who is looking to mitigate sequence of returns risk would probably not be 100% equity in retirement. When we look to the S&P 500, during the 2008 financial crisis, somebody who owned the S&P 500, yes, 100% in retirement, 100% equity, would have been in very big trouble. But somebody who owned a 60-40 portfolio, it not only had substantially lower volatility, but it took the S&P 500, I believe it was almost 6 years to catch up to the returns of the 60-40. So this is all an assumption that you're 100% equity in retirement, which is what most dividend investors will do, because ultimately they're basing their income off dividend yields, because equity typically yields more than fixed income. So they will set a retirement goal based on, say, a 4% yielding portfolio, but that's from dividend stocks. So I would argue that these drawdowns, you're actually putting yourself at more risk by focusing on dividends, because again, you're not following the basic principles that have been outlined for decades. Build cash reserves, transition some of that into fixed income investments like GICs, bonds, annuities, and you substantially lower your overall volatility, and you can still withdraw. You can maintain flexibility in retirement because I believe the 60-40 portfolio lost less than half of the S&P 500 during the crash. So ultimately, I mean, it just doesn't really abide by the principles of what many, many highly educated, accredited investors who've researched the topic, won Nobel Prizes, have told you to do to mitigate sequence of returns risk.
Okay, a powerful final statement there. Thank you to the both of you for putting together some really fantastic arguments and some fantastic counterpoints as well to kind of help our investors kind of wrap their heads around this really important question. Before we get our viewers to make their final decision here, Kanwal, I want to start with you, a question that I had. One of the things that I think we have to keep in mind when we're living off of dividends is if we want to live a pretty comfortable retirement lifestyle here, you could potentially need a really big portfolio of dividend stocks, given that, you know, even like the blue chip ones that, you know, it might be perceived to be more safe, more consistent payout histories and stuff like that, they typically pay somewhere in like the 3-ish% range, maybe 4, maybe on the upside 5. You would need a really big portfolio to accomplish that. And I think a total return investor like Dan might argue that with a total return approach, you could probably save up less money, and albeit you're selling shares, but you don't need to build up such a big portfolio to live off of in the same retirement period. What would you say to that criticism?
Yeah, Rob, so that's a good, important comment. You know, the average dividend yield today, if we look in Canada and the US, is roughly around 3.5%. And you're right, there's some companies that are paying yields of 5, 5.5, 6%. And then there's some that are paying 1% or 2%. So let's just go with the average, 3.5%. And you're right, if somebody's starting out today who did not have any investments in individual like dividend stocks, if you're starting off today and you want to make $35,000 a year in dividends, well, you're going to need to invest $1 million, right? 3.5% of $1 million. And that is a lot of money. I don't know about you, but I don't have $1 million lying around. The key to this, and this is what I've been teaching for many, many years, is you need to start early. The younger you are, the better off you're going to be, right? You need two things to be successful as a dividend investor, and that's going to be time and money. And if you have both, even better. But most likely when you're young, you have a lot of time in front of you. You don't have a lot of cash. The sooner you start, the better off you're going to be, right? So somebody who started in their 20s with their first job and started putting money aside and putting into dividend stocks could absolutely be making more than 30, 40, 50,000 a year today. Fast forward, assuming they're in their 50s now, easily. And you did not need $1 million to start with, right? The perfect example quickly I can give you is one of my friends, Bob, who runs Talkhand is the blog site. He profiled a Canadian couple who are today earning over $360,000 a year in dividends. They started with $10,000 over the last 36 years, invested only in dividend stocks, and that's where they are today. That's astronomical. I don't expect everybody to be making that much money, but even if you could get to half of that phase, you'd be fine. So even if you're in your 30s and 40s, it's still not too late to get started. If you're in your 50s and 60s, still not too late. If you live up to 85, 90, you've got another 20, 30 years to go, right? So it's still not too late. And generally, if you're in your 40s and 50s, you've had a career working many decades. So you've got more money available to you to start investing in dividend stocks.
Yeah, I mean, certainly it's talked about the dividend snowball, where if you can start early enough and you can build it up over time, you can really start amassing large amounts of dividend income over time. So certainly time is a benefit to any type of investor, but it certainly rings true for dividend investing as well. Although one thing I would like to also point out here that maybe didn't get touched on as much in our conversation here is, I guess, the inefficient timing, if you will, of dividends potentially. In that example, you know, that couple earning $360,000 dividend income, that sounds fantastic, but consider that, you know, over half of that is going to get clawed away at the highest marginal tax bracket. So you're really making half of that because you don't get to choose when you receive the dividend income. It's paid quarterly, annually, what have you. And I think some people would argue, some skeptics would say, you know, you're going to be losing things like income-tested benefits, like old age security, OAS. It's going to be clawed back, GIS potentially, guaranteed income supplement, if you were to collect that as well. And then the other thing too is when you eventually, you know, kick the can here, your estate is going to have a massive tax bill, basically, and you're going to lose half of that portfolio. What would you say to the skeptic that's saying, look, this sounds like a really inefficient way to live off my investments?
Yeah, so those are good points. And of course, we want to remind the audience that any dividends earned inside of your RRSP and the TFSA are going to be tax-free, right? So that's one thing. So you'd want to max out your TFSA and then max out the RRSP as well to save on the taxes. Getting a clawback on your OAS later in life because you earn too much dividends, I would say is a good problem to have. You know, I'm half joking, but it is, right? And, you know, would I rather make 100,000 in dividends a year or make 20,000 because I don't want to get OAS clawback, right? I'll take the 100,000 dividends every year, right? So that's a good problem to have. And same thing with the estate, right? You're going to, it's something that you could leave to your children if that's what you wanted to do. Leave money to the family. There's no way getting around the taxes, right? As they say, the government's always going to get their tax. So there's no way getting around that. But again, you know, my goal is to invest as much as I can, to build a portfolio as large as I can and get enough dividends. And if I'm successful, well, when I pass, the government's going to take a big chunk of that, right? What's the alternative, right? Put it all in GICs and then just earn way less? I don't know. I'll leave that up to the audience to figure out.
Well, I think the alternative might be, you know, if you're spending down a large part of your portfolio, you will have, I guess, maximized the opportunity cost of your money, I suppose would be the argument there. But in any case, thanks for responding to my follow-ups there. Dan, over to you. I do have a couple for you as well. One of them being that it's generally true that people are kind of living longer than ever. And that can obviously increase the risk that they're going to outlive their nest egg potentially if they're selling shares to fund their lifestyle. You know, again, kind of a good problem to have. You lived longer, hooray, than you expected, but now you don't have any money necessarily. So what would you say to an investor who's kind of concerned about that aspect of things if they were to pursue a total return approach to investing rather than living off of dividends?
Yeah, the one thing I just want to mention before that is the RRSPs. Like dividends inside of an RRSP aren't tax free; they're just tax deferred. Like you will pay tax on those dividends when you pull them out. So it's you contribute, get a tax refund, and then when you pull them out, you're going to pay tax. So they're not tax free. The TFSA would be, but I mean, for somebody who's worried about possibly outliving their retirement income, I mean, that all comes down to retirement planning. I mean, you need to understand, you know, how much you want to earn, how much you know, and it all comes down to as well as that, like I had mentioned, that diversification of assets. I mean, you don't need to be all equity, 100% going into retirement, claiming those dividends. I mean, there's safe assets that really don't have as much volatility as stocks that could allow you to kind of weather that storm. And I mean, when we think about an actual dividend versus, say, the sale of shares, they're the same thing. Like from a actual dollar value standpoint, I mean, when a company pays a dividend, it comes out of the retained earnings. The company is reduced in value and your shares go down. I mean, it's actually like the brokerages, they regulate that. They mark the shares down by the dividend paid. Now, a lot of people don't think that this happens because, market activity throughout the day, the stock might fall less, the stock might fall more. But I mean, in reality, the companies that are paying you dividends are worth less after they pay you that dividend. So, I mean, the selling of shares, you're effectively receiving a dividend that is worth from a company that's worth less, or you're selling shares from a company that's possibly worth more. I mean, I could go into a lot of examples, and I did have that big write-up laid out at the start of it, but I kind of thought I didn't want to go too deep into that. But I mean, ultimately, it all comes down to retirement planning. You need to understand that, well, and actually I want to go back to the point that if people are living longer, that should be a larger advocation for. If you have a long time horizon, you should be trying to maximize your returns as much as possible. You should be deferring your tax, which capital gains do, dividends do not do. You need to be trying to maximize your returns. And again, there's a lot of criticism sometimes from myself. Like, I take a lot of criticism where I say maximize returns. A lot of people think I'm saying chase, higher growth stocks. I mean, I'm just speaking strictly from a broad-based index level. I mean, even if we look to kind of a benchmark portfolio that's 65 Canadian, 35 Canadian US that I did with the aristocrats, I mean, it's trailed the S&P 500 by nearly 5% annually for the last 15 years. I mean, if you think of how much money you would actually have in retirement if you optimized your portfolio for total return, because I don't know the numbers right off the bat, but I mean, I'm going to tell you a 5% annualized return over the course of 15 years, that's going to buy you years of retirement. And then, I mean, when you get into retirement, I mean, again, that number one risk mitigation in terms of sequence of returns risk is you diversify your assets. You don't you don't need to fear a 40% market correction unless you're heading into retirement with a 4% yielding dividend portfolio, you're 100% equity. That's when the fear really starts to come in. And I mean, you can diversify away from that. Yes, you might need maybe more money because fixed income doesn't pay as much. Treasury bills, GICs, fixed income annuities, maybe they don't pay as much. But that's actually a stronger indication that you should be maximizing your total returns early so you ultimately have more money when you do retire. And you can diversify these assets and just maintain your flexibility when you are retired in terms of, how you're going to fuel your retirement.
Yeah, I mean, certainly if you have more money to play with over a longer period of time, potentially, that can certainly help with the longevity issue. I kind of want to circle back to the volatility aspect of things too, because retirees, generally speaking, just hate volatility. And if you look at the S&P 500's dividend aristocrats, these being that, the dividend payers for at least 25 straight years here consistently, they have, generally speaking, outperformed the broader market during down markets. And that's when volatility is the highest. That's when emotions are running high and retirees are likely to panic. So would it not make sense in some regard to have exposure to companies like that pay that reliable dividend income and kind of lean on them when times get toughest?
Yeah, I mean, I guess I would go back to that point that there's no guarantee that a company who has paid a dividend in the past can pay one in the future. So I had a look at the Canadian Dividend Aristocrat ETF, which would be the iShares Dividend Aristocrat ETF. So this contains all of Canada's dividend aristocrats. So they were a little bit more lax. So they're only 5 years. Once you raise it by 5 years, they put you in the index. When COVID hit, the distribution from that fund was slashed by around, I believe it was around 35%. And then it took 3 years for them to actually get back to their pre-COVID levels of income. When we look to the U.S. Aristocrat Index, I actually didn't look at how that fared into the pandemic. I would have had to gone back and look at that. But dividends they're never guaranteed. I mean, if you're heading into into retirement with 100% equity portfolio and you're solely relying on those dividends, and then say a market event happens that hasn't happened before, and the worst hit sectors are, let's say, Canadian financials and Canadian energy companies, because that is where 50% of the Canadian dividend aristocrats lie. Say there's a material event that impacts them and their dividends get cut. You have amplified your risk significantly, because now your dividend income has probably gone away, and now you're probably going to have to sell shares to probably fuel your retirement. So I just think, like, overall, they're very concentrated in a select few sectors, especially in Canada. The US is a little bit more diversified, but if you want a high yielding stock here in Canada, you're probably going to financials, energy, maybe utilities. And constructing a portfolio of those, it doesn't matter if a company has paid a dividend for 50 years, 100 years, 150 years, they can be cut. There's been plenty of instances. Again, I bring up 3M. Obviously, I would have to go through and see, how many often those companies cut their dividends, but the cuts happen. It's never a guarantee. Companies are not obligated to cut dividends. We're in a situation like, say, a fixed income investment. They're obligated to pay that debt, that coupon payment, over a dividend. You know what I mean? So that sort of income, that sort of fixed income end of things. And again, kind of diversifying your assets, exactly what a lot of, very smart people say you should do, kind of prevents that.
Yeah, certainly diversification, often trumpeted as the only free lunch in investing. So there's certainly value there. Okay, listen, a big thanks to the both of you for sharing your positions for and against living off dividends in retirement. We're fast approaching the moment of truth here to find out who our audience thinks won the debate. So let's put up the poll on screen there to have our viewers vote. Is living off dividends a good idea in retirement? Who more swayed you? What do you think now after hearing the arguments both for and against? Yes, living off dividends is a good idea. No, living off dividends not a good idea. Let us know what you think. Cast your vote here. And again, for those on YouTube, if you're watching on the live stream, you want to make your voice heard, you want to have your say, follow that link in the description. You can join the broadcast platform here. You can cast your vote. And we're going to reveal the answers in just a moment here. But just quickly, while you guys are voting here, just some programming notes here, if you will. Both Dan and Kanwal produce fantastic content. They're really sharp investing minds here. And so in that spirit, we've provided links to their websites, their social media content, as well, that you can check out in our resources section, as well as some related resources and past episodes that we've had, for instance, that you can check out if you want to learn more about today's topic. But I encourage you to check out the work that they do if you're interested in hearing more about the way that they approach investing. I see some people in our audience here asking for some specifics from both of you in terms of like what you guys invest in and how you're building your retirement portfolio and stuff like that. Probably not the forum to do that right here, but perhaps you can follow up with them if you're interested. There's links available for you there too. Also, we run this show every single week, Inside Investing, and we have many interesting topics coming up here. You can check out in the console here some upcoming episodes we have. Next week, we're going to be talking about investing in IPOs, the do's and don'ts, if you will. 2025 shaping up to be a hot year for IPOs. After a bit of a lull in 2024, we're going to have a DIY investor, Craig Stevens. He's going to give us his perspective on some of the best practices that he uses to invest in IPOs. And also after that, we have social media superstar, if you will, Jasprit Singh, excuse me, from Minority Mindset, politics on the brain here. He's going to talk to us about the benefits of investing during market downturns, bubbles popping, economic recessions, all worries that we have heard about here in recent years. And it's something that's top of mind for many investors. These can be opportunities to accelerate your wealth. He's going to talk about some of the strategies that he has used to do that and what others can take away from that. And just one last final thing here. You can follow TD Direct Investing and Inside Investing here on our social media channels. We have TD Direct Investing on Instagram. We're on YouTube as well. You can check us out there if you don't already. Give us a follow, give us a subscribe. We would very much appreciate that. Okay, so the moment of truth here, guys. Thanks to all who voted in our audience here. Let's have the big reveal here. But first, as a refresher, let's take a look at what our audience felt coming into this debate. How did they feel about things here? So the heat check was we had about, call it 75% saying, yes, living off dividends is a good idea, 25% pushing against that idea. Let's get the results reveal. What does our audience think? Who won the debate? Let's cue that up here. Okay, living off dividends now polling 56%. So that means, Dan, congratulations. You are the winner of today's debate. You have swayed some of the dividend diehards that were coming in hot. You've managed to pull them over to your side. So well done. Some fantastic arguments you made here. How does it feel? You are the champion.
It feels pretty good. I mean, investing, it's such a personalized issue. There's a lot of things to take in. I mean, often you can get like overwhelmed with the amount of information, but I mean, generally there's a lot of studies that just kind of prove that total return is the most optimal situation for most people. And it's just been something that I've advocated heavily for years.
I think you made some fantastic data-driven points in your arguments there, and I think that may have tipped the scales in your favor. So it's always great when we can reference historical data and the real trends that we're seeing here. Kanwal, you made a valiant effort, certainly, and you had some fantastic arguments as well. Unfortunately, you're on the losing end of this one. Your thoughts?
No, congratulations to Dan. Well done. This was a lot of fun. I really enjoyed it.
I think the key takeaway that hearing arguments from both of you here is that ultimately, your personal preference, your personal circumstances are really going to play the ultimate factor here, regardless of what the academic arguments say, regardless of what the historical data says. So maybe on that note, just quickly, Dan, what kind of investor do you think would prefer a total return approach versus living off dividend income? Is there a certain type of personality you think lines up better with that?
I think it's difficult to say just because I advocate it so much for everybody, but I mean, I guess somebody who really, really fears market drawdowns and kind of can't get over that element of, that fear of loss. But I mean, I still think it would be better to optimize your portfolio for total return. I mean, I think that fear of loss, that risk aversion that people are so obsessed with, rightfully so, like that, it's a huge thing, especially when you get into retirement. But I think that can be mitigated other ways much more efficiently, as mentioned, stated, by numerous studies rather than just focusing on dividends. So I'm a bit biased. I think every investor should be focusing on a total return strategy, which again includes dividends. Just to, again, those three core elements. You maximize your flexibility, you stay more diversified, and you kind of, asset allocation, deciding, how much equity exposure, fixed income, annuities, bonds, GICs, things like that. There's so many different elements to it.
Mm-hmm. Yeah, all good points there. And Kanwal, kind of same question to you. Do you think there's a certain type of personality that might lean towards living off dividends in retirement as opposed to total return?
Yes, absolutely, Rob. It's going to be, for someone to be successful with dividend investing, you really have to have the patience, the desire to learn about what to invest in, how to invest in it. And so really what I tell people is, for those that have no interest in sort of learning or the desire to learn, then you're going to have to go with sort of the broad index ETFs kind of thing. But if you're looking for stable, reliable, consistent dividend income year after year, you really have to have the patience and a long-term perspective to investing, right? So you got to be able to ride out the downturns when they happen, and they will happen. And you've got to have the discipline to stick with the approach.
Yeah, all great points, guys. Thanks again for taking the time to debate with us here. Really fantastic conversation. We did run a little bit long, so I'm wondering if you guys can maybe hang on for an additional 10 minutes or so, just so we can get some audience questions in. We're done the debate portion, but we're not totally done yet. We do want to take some questions from our viewers that they had outstanding. Is that okay with you guys? You guys okay to stick around for a bit?
Yep.
Yeah, I'm good.
Wonderful. Okay, so without further ado, then let's get to some questions. The first one that we have coming into us here, this is from Loris. Loris is asking, let me just call it up here. Please define what is considered an undervalued stock. Kanwal, you're the one who brought this up, so I'm going to send this one over to you. What do you think?
Yeah, absolutely. So the way I look at it is I take a look at the current dividend yield for a stock, and I'm going to compare it to the stock's average 20-year dividend yield. So if the current yield is higher than its average 20-year dividend yield, then I consider the stock to be undervalued and priced low. If the current dividend yield is less than its average 20-year yield or equal to, then we consider the stock to be overvalued or priced high, and then we ignore it, right? Because we don't want to overpay for our stocks.
And Dan, maybe I'll send it over to you too. So that's how Kanwal is defining undervalued stock. What about you? What's your approach to doing so?
I mean, there's the definition of undervalued completely depends on the investor. I mean, I've known some people who believe particular stocks are overvalued while I believe they're undervalued. I mean, valuation is just completely subjective to the individual person. The one thing I would mention is the difficulties when we get into analyzing yields, which does, sometimes it can be an indicator. But I mean, again, we look to a situation like BCE, well above their historical yields. But I mean, it hasn't really worked out all that well. And I mean, free cash flow, ultimately the market is going to be driven by earnings growth. They don't care about the dividend. They don't care about any of that. The market is going to track free cash flow growth and track earnings growth, and it's going to be an accurate representation of that over the long term. I mean, it doesn't exactly work on a linear basis. I mean, the markets can go absolutely bonkers over the short amount of time, but generally you see that, most indexes grow based on earnings growth over the long term. So that is ultimately the most important factor, is that earnings growth and free cash flow growth. And I mean, from an indexing perspective, you don't need to worry about any of that. Especially if it's a basket of a lot of individual companies. I mean, you simply just own the index, which is generally going to be filled by companies who grow free cash flow and grow earnings.
Mm-hmm. Okay, thanks for the color from both of you guys there. Let's keep this train rolling here. We have a question from Stephen coming in. Stephen wants to know, in retirement, is living off dividends, would it be best to use a portfolio of ETFs or individual quality stocks with smaller dividends, but greater potential for capital appreciation? Kanwal, over to you for this one. What do you think?
Yeah, absolutely. So I'm going to be obviously siding with individual quality dividend stocks. So in my opinion, that is the better approach. The ETF is you're buying a basket of stocks. And in that basket of stocks, you are going to get stocks that are not quality stocks. Like I gave the example in the beginning about a very high debt level versus a low debt level. Right. And there's other things, right? Payout ratio or all that and earnings history. So with ETFs, you buy everything in that ETF. So you're inadvertently buying stocks that are not quality stocks, inadvertently buying stocks that are not priced low or undervalued. And then on top of that, there's going to be the management expense ratio, the annual fee. So I don't want to be paying any fees either.
And Dan, maybe you could give us the other side of this coin, because you seem to like, the index approach or the ETF approach in some cases. What would be the upshot of using a dividend ETF as opposed to building a portfolio of individual dividend stocks if you were to go that way?
So, I mean, me personally, I don't own any ETFs. I own individual stocks. I mean, that's just a personal preference by me. But I mean, I can imagine if I'm in retirement, the last thing I want to be doing is keeping tabs on 25, 30 different equities that I own. I mean, it just makes so much sense to go from a broad indexing perspective. Like the ETF environment these days, the fees are getting so low. There's so much competition, which ultimately benefits nobody but the retail investor. I mean, we can see, broad-based index funds that are like 5 basis points. So you're paying next to nothing, 50 cents on a $100 investment, to one-click it and never have to worry about it again. Ultimately, I know that's what I will be doing in retirement. Whether or not that's right for you, that completely depends. But I know I'm going to be doing other things rather than keeping tabs on 30 different holdings.
Yeah, certainly there's some legwork that goes into it. And perhaps in your golden years, that's not what you want to do. Some people love it and they will gravitate towards it. But yeah, some people, it's just not for them. Okay, let's keep going here. We have another one coming in here from Sydney and Paulo. And they want to know, what do you think about taking a middle of the road approach, as they call it, to retirement income, where an investor has, part of their portfolio in dividend stocks, and then the other part is kind of focused on total return, maybe through indexing and something like that. What do you guys think about that? Dan, maybe I'll start with you.
It's difficult. I would kind of argue as to why. I mean, again, when we look to dividend stocks, dividends are a portion of total return. So if you want to structure half your portfolio to be dividend stocks and the other half to total return, I guess my answer would be, I mean, if dividend stocks are, if dividends are a part of total return and you're trying to align half your portfolio for total return, why wouldn't you just align the whole thing? Yeah, that's kind of what I would say to that. I mean, ultimately, I'm 100% advocate for achieving maximum returns with the smallest risk possible.
And Kanwal, maybe you could share your thoughts on that as well. What do you think about a middle of the road approach to things here?
Yeah, so absolutely. I think it's quite possible, middle of the road approach. You could do that. What I would suggest is, again, in my opinion, I think the key and the priority is to make sure that there's enough dividend income to cover your living expenses. So whatever that is for you, for some Canadians, it's going to be $50,000 a year, $80,000 a year, or $100,000 a year in dividend income, right, to cover their living expenses. That should be the priority, because that is the foundation of your total financial security, right? Once you get to that point where the dividend income is covering all of your living expenses, then if you want to go after high growth stocks or stocks that don't pay dividends because you believe that they will outperform the stock market, then you can certainly go ahead and do that, because then at least your financial security has been established and you're safe in that end, and it will not affect your lifestyle.
Okay, yeah. So setting that floor with the dividends, and then the total return is sort of the gravy on top, so to speak, is kind of what I'm getting from that. Okay, let's go to another question here. This one from David. First, I'm just saying, thanks to the both of you. Your knowledge, seriously appreciated here, and of course taking the time. I would echo that sentiment there, David, Kanwal, Dan. Really big thanks to you guys. David says, I'm 18 and currently attending university in Alberta. What would both of you advise to a young investor, small portfolio, limited capital, to do to gain returns and build a stable source of income? Kanwal, why don't we start with you?
Yeah, absolutely. So I think by now your audience is going to know what my answer is going to be. And that, again, based on my experience, I've been doing this for more than 25 years. I've met a lot of young folks, and that is the best time to start. So for this listener at 18 years of age, amazing. That is an incredible time to start. The younger you are, the better off you're going to be. What I would suggest is, of course, it's going to be individual dividend stocks, but not just any stock. Make sure it's a quality stock. Make sure it's undervalued when you look at it, right? So that's where you want to start. If you've got room, I don't know if this person has a job or not, but if you've got additional income that you can invest, even better. I would suggest to max out the TFSA first, put that in there, and that's going to be your starting point to start building a stable source of income. And then we talked about financial security in that previous question. You're starting at 18, keep doing what you're doing, and you're going to get to that point. One last thing with regarding ETFs and income funds and mutual funds, you could, and I'm sure Dan is going to suggest this, and why not put the money into a dividend ETF or a dividend income fund? The only thing I want to mention there that we didn't cover today is generally you'll find that the dividend yields on those types of funds are lower than what I could get with individual dividend stocks.
Right. And, you make a good point there. At 18, David, you're on the right track. You're already thinking about things and you're investing future, and that's not even on the radar for a lot of people. So you've almost done the hardest part, which is getting started. Dan, over to you. And this will be our final question here. But Dan, over to you about what you think someone starting out early in life here at 18 years old, like David is, what could they do to get the ball rolling for themselves and build an income stream?
I mean, I guess I would argue at 18 years old why exactly you would need an income stream, unless you're talking about possibly you want an income stream when you retire. I mean, it would simply be a total return approach to investing. I mean, if we think of somebody who is 18 years old, which, by the way, good for starting early and a fellow Albertan. But if we think about starting that early, we have 30, 35 years to just invest in, broader indexes, whether you want to choose individual stocks or not, that's completely up to you. But in the case of a broader index, you invest in that, hold it for 30, 40 years. Total return is ultimately going to allow you to have more capital in retirement. I mean, a simple simulation, if we look to $100,000 at 8% return, say for 30 years, it's $1 million. However, if you buy, say, a broad-based index fund and it returns 10% annually for that 30-year period, you're talking about an additional $800,000. So that is the huge implications of possibly sacrificing total returns with a long time horizon over structuring an income-based portfolio. And I see a lot of people who are like, they're in their 20s and they're calculating their passive dividend stream. And I just kind of begin to wonder, like, why wouldn't you just be aiming for that total return? And I think I do want to go back to the information mentioned with the person that was generating, $300,000 in dividend income. I don't want to make any kind of assumptions with him, because I didn't read the article, but I see this so many times, and often what is hidden behind these large amounts of dividend income is a high rate of savings. That is the most important thing you can do. Dividend income, you just need more money to generate it. You can ultimately increase your income stream by having more money. And how you can achieve that is by aiming to maximize your total returns while taking the lowest risk you're comfortable with, which again would be ignoring the income stream when you have 30, 40 years left in your working career.
Right, keeping the eye on the prize there long term ultimately is what you're going to need if you're talking about for retirement here. So anyway, thanks for that context, Dan, and thank you, Kanwal and Dan, for the both of you guys for sharing your thoughts, weighing in on this debate here. It's a popular one. I hope we helped our audience get a little bit of a clearer picture on the pros and cons of each approach that they can use to help inform their own investing journey. And for those in our audience, thank you so much for tuning in. Really hope you got some value out of this. Dan, Kanwal, again, really appreciate you guys taking the time. We hope to have you back again soon. A round 2 of a debate, and we'll pick a different topic. How about that? Would you guys be up for that?
Absolutely.
Oh, yeah, for sure. It was fun. All
right, good.
Thanks for listening, everybody.
Yeah, really appreciate it. And make sure to check out our upcoming episodes. Make sure to check out our library of on-demand content as well, and those resources that I mentioned. You can check out our guest speakers as well and the content they produce as well. Thank you so much, everybody, for joining. We're going to leave it there for today. Enjoy the rest of your day and continue to learn about investing. Good stuff, guys.